Welcome to another episode of Trends and Ideas. I'm your host, Brian Egley. For companies within the automotive industry, 2013 has been a strong year for both profit growth and stock appreciation. Will 2014 pave the way for more gains? Here to discuss this is S&P Capital IQ equity analyst Ephraim Levy. Welcome, Ephraim.
Well, thank you for having me.
Ephraim, let's begin with clarifying what kind of companies we're talking about here. We've got automakers, auto retailers, and auto parts companies. What's been driving the growth?
Well, it's been we're coming off a recession of several years ago where we had really low auto sales, and we've been growing ever since. And that factor has been pushing up the industry. But besides recovery, we're also having the fact that the average age of a vehicle now is over 11 years old. That means that people are going to be looking to replace their vehicle, get something fresher. There's a lot of new styles coming out, a lot of new technology in the vehicles. There's a lot more fuel efficient cars out there. They get better gas mileage, and therefore people are ready to look and get a new car. And once you have a job, you either need to get to work or you can afford to buy another car. So those are things that drove 2013 sales.
Great. 2013. Moving ahead to 2014, what's in store for the industry in your view?
Well, it's a little bit of more of the same, just a slower rate of growth. We're looking for 3.3% growth in new light vehicle sales volume. That would bring us to 16.1 million units, and that's compared to the 15.6 million forecast that we have for 2013, which represent an 8% growth. And internationally, the manufacturers should also benefit as we see global growth led by China, expanding demand for vehicles, so that's another opportunity for them to grow their profits and sales.
Okay, so further growth we're looking for, but maybe not at the same clip we've seen in 2013.
Exactly.
Now, based on that, do you have a stock recommendation you could share with us today?
Sure, Ford. Ford has been executing very well the last few years. It's the one domestic automaker that did not have to go through the bankruptcy proceedings. And what they should benefit for is as we discussed, the U.S. sales are growing. Their profits in the first 3 quarters were at record levels on a pre-tax basis in North America, but they're also expanding in China, where they've been a laggard. And even as they invest in China and Asia, they're actually growing profits, but the real profit growth is being masked by the continued investment that they have now and we expect for the future. And finally, in Europe, where they have an important presence, that has been really weak, but we see stabilization for 2014 as well as profit improvement, or rather loss mitigation in 2014 as Ford continues to restructure. So that's why we like Ford. We think it's an attractively priced stock.
Very good. Thank you, Ephraim.
You're welcome.
For more of Ephraim's stock picks and views on the outlook for the automotive industry, we encourage our MarketScope.com subscribers to read a related Trends and Ideas story on MarketScope Advisor. It's called Firm Demand Should Keep Auto Stocks on the High Road. Until next time, thanks for watching or listening. I'm Brian Egley for S&P Capital IQ.